Hello friends, welcome back to another video. Today I want to share my thoughts on CROCS Incorporated, ticker symbol CROX. If you had followed this company before, you will know that the stock price went from the $7 low it hit in March 2020 all the way up to $180 a couple of months back, and with the recent overall market correction, it is now trading at $102 at the time of recording this video. So today, I want to discuss why the stock price appreciated so quickly and what we can expect going forward. Upfront, I want to say that I have not yet invested in the stock, and I'm still not fully convinced if the current price is right to start a position. But I still wanted to share my thoughts on their growth potential and risks, and also wanted to hear from you in the comments on what you think about this company. So as many of you, at least in North America, would know, Crocs is a casual footwear company, and their products are very trendy and comfortable to wear. I personally own some of their products and always liked them, but had never invested in the stock before, so I found it very interesting to research their financials for this video. The main reason for the stock to go up significantly in 2020 and 2021 is because their revenues went over the roof during this period. As you can see here, their Q3 2019 revenues were at $313 million, which grew to $362 million in Q3 2020, and then increased 73% to $626 million for Q3 2021. You can also see that their Q3 2021 diluted EPS was also 163% higher than their Q3 2020 numbers. Such a high growth in their revenues and profits got the market really excited and caused the stock price to increase. Now the main question I had when researching the financials is whether such high growth rates can be sustained for a few more years to come, and this is where the main risk lies. As you can see here, if you look at the revenue trends over the last 5 years, the company never had consistent revenue growth except for the last couple of years. There were periods in between where the growth rate was even negative. So in summary, we really don't know if the recent success the company had is temporary and if the revenues will flatline or even decrease going forward. On the positive side, we could argue that the recent growth could be really driven by strategic initiatives taken by the management, including partnerships with celebrities, increased focus on digital sales channels, and acquisitions to drive future growth. Talking about acquisitions, Crocs just recently acquired Hey Dude, which is another popular casual footwear company. As you can see here, Crocs paid $2.5 billion for this acquisition, which is around 5 times Hey Dude's 2021 revenues. This acquisition is expected to add around $700 million in revenues in 2022, and if Hey Dude continues to grow revenues at historical rates, then it can create substantial value both in terms of top line and bottom line growth. Let's now look at the financials in little more detail. As I mentioned before, the company's revenues exploded in 2021 to $2.3 billion and is expected to be 67% higher than the 2020 revenues of $1.4 billion. The non-GAAP operating margin for the year is expected to be an impressive 30%, and the company also reported share repurchases of $1 billion. Overall, the company had a very impressive 2021, which is again the reason why the stock price increased rapidly for most part of 2021 until the overall market weakness caused the stock price to come down. In terms of future outlook, the company expects to continue growing revenues in 2022 to $3.5 billion, combining both Crocs and Hey Dude. By 2026, the combined company expects to increase revenues to $6 billion. The company also expects to keep their operating margins at around 26% during this period. These are great future estimates, but obviously the question is whether they can achieve these estimates or if the revenues will stay flat, especially if we have a recession or increased competition. Before we get into valuations, let's now take a quick look at some fundamental metrics of the company. So as you can see here, the current market cap is at $6 billion at the time of recording this video. The price to sales multiple stands at 3.07 compared to a 5-year average of 1.68. This is just a result of the market assigning a more bullish multiple due to the increasing revenues in the recent quarters. The price to book value is at 18.58 compared to the 5-year average of 10.43, again pointing to the richer valuation the stock is currently trading at. On the positive side of things, we can see that the price to free cash flow multiple at 14.97 is significantly lower than the 5-year average, as the company managed to drastically improve their operating and free cash flow margins in the recent quarters. In terms of financial strength, the current ratio is at a healthy 2.63, and the total debt to total assets is also at a very manageable rate of 16%, so the overall financial health of the company looks pretty good. Now let's discuss valuation using some scenarios to estimate the future revenues and profits and see if it is worth investing in CROCS at the current stock price. As usual, here I have drafted 3 scenarios with different revenue growth projections of 5, 12, and 15% in each scenario over the next 5 years. The 15% growth projections is in line with what the management expects, so I am listing this as the bullish scenario just to be conservative. I have also estimated the future profits and the price to earnings multiple under each scenario. So based on these estimates, we can make an astounding 24% annualized return if the company manages to execute scenario 3, and even under scenario 2, we'll get a reasonable 9% annualized return. Obviously, scenario 1 is the risky one, as we'll lose a lot of money if the company fails to grow revenues as expected. Personally, I think they should be able to grow revenues at least around 10 to 12% per year, given that the brand is fairly popular and they also have a lot of potential to expand into international markets. But given the current market condition, I do feel that there will be better opportunities in the short term to buy the stock in the high 70s or low $80 range, so I'm not going to rush and buy at the current price. However, I'll be selling an $80 put option expiring in March 2022 to take advantage of the elevated option premiums. So as you can see here, this would give me an annualized return of over 24%, while also providing a downside protection of around 21.5%, as I won't lose on this trade unless the stock price goes lower than $80. Anyway, do let me know your thoughts on CROCS and what you think of its future growth prospects. And I hope you liked this video, so please don't forget to hit the like button and subscribe to my channel. And as a friendly reminder, I'm not a licensed investment advisor, so always remember to do your due diligence before making any investment decisions. That's it for now. You have a great day, and I'll see you in the next video.